Hi everyone, welcome back into another video from XLpips, and this is episode 3, the third episode of XL Charter Public Mentorship. And I've been posting videos about the XL Charter Public Mentorship, and this is the another series where I'm just covering different concepts which are very important to learn and to understand. Okay, so today's episode is going to be about why you fail with smart money concept and ICT. So I've seen a lot of traders, a lot of mentors teaching students, explaining to students, talking about liquidity, talking about investment, and still there's a large number of people who are actually failing with this smart money concepts or ICT concepts, and that's one of the reasons that's making a lot of other traders and gurus and fake gurus creating new concepts to traders, trying to tell them like that's the missing gem, or that's the only secret that is missing in their strategies. And the reality is there is no any secret source, any secret concept that's going to actually be very different from what you already know. Okay, so it's just a repackaging of stuffs and trying to actually sell concepts and courses to traders with different names, but just the same concept. Okay, so the main problem when it comes to why a lot of traders are still failing to become profitable with smart money concept or ICT concepts is because of the lack of understanding of liquidity and inducement traps. Okay, so I've created this video so that I may explain everything about liquidity and inducement. So if you want to master everything about liquidity and inducement, which is a very important thing to learn in any strategy, you must learn about liquidity. Okay, because the market is moving depending on liquidity. Okay, so liquidity is what moves the market. It's like the fuel of the market. Okay, so don't skip anything from this video. So watch this video and make sure you have a notebook so that you may write down some other concepts if you want to actually become profitable. Okay, and then go and back test, and you will see a new world being discovered from this video. Okay, so let's start by actually talking about liquidity and inducement. Okay, so many people still fail in trading even though they have a good understanding of smart money concept and ICT. And the biggest cause is the lack of understanding of liquidity and inducement concepts. So many people know about smart money concept and ICT concepts, but it becomes a problem when it comes to understanding about liquidity and inducement, and on how you can actually master this concept of liquidity and inducement. Okay, so you need to understand and master inducement and liquidity before you can start trading or placing any trade. Okay, so now what's exactly is inducement? Okay, so you may ask yourself, like, why does it look like liquidity and inducement are the same thing, but they are different? Okay, so liquidity is different from inducement, but they have similarities. Okay, but they are not the same thing. Okay, so inducement occurs at a specific point or zone in the market where traders believe it is a correct time to enter a trade based on their analysis and trading system. Okay, so inducement is always it occurs where, like, a lot of traders are expecting like the market's going to react from that zone. Okay, so a lot of people will actually having, like, they will, most of them will just like to take trade on a particular point or zone in the market, expecting price to react from that zone. So if there is a lot of orders, a lot of actually traders trying to take trades on a particular zone or point in the market, which they believe that that's um, the correct area for them to take a trade based on their analysis, then most of the time that area will always becomes an inducement. Why? Because the market is most likely expected to actually sweep that zone before the true move. Okay, so when there are a lot of traders or retail traders have actually mark the certain zone as their area of interest and expect to trade from that level, then you will find out that the central banks or the financial institutions or the smart money, they use those zones to fall traders into traps. Okay, so those zones are going to be used as traps, and a lot of people actually going to lose their money from that zone because that's going to become an inducement trap. Okay, so and how exactly, you may ask yourself, like, how exactly can you find inducements? Okay, it's very simple. Okay, so if you want to understand about inducement, remember inducement is the zone that most of the traders are going to expect to execute from that zone. Okay, failing to actually look at price action clearly and understanding that that zone may actually look as a good entry point, but it's not a good entry point, but it's an inducement. Okay, so now let's us actually know and master and know, like, how can we actually understand that this is not the good point of interest or the good entry zone, but it is an inducement trap. How can you actually know that? So you need to know where exactly can you find inducement. Okay, so we find inducement where we have order blocks, where we have support and resistance zones. Okay, where we have the swing levels, which are swing highs and swing lows, or where we have the trend lines. These are the four examples of where we can actually find inducement. So I'm going to cover one after the other for you guys to understand why am I saying we can find inducement where we have order blocks, and why am I saying like we're going to find support, supposed to find inducement where we have support and resistance. Why am I saying we may find inducement where we have swing levels, and why am I saying we'll find liquidities or not liquidity inducement where we have the trend lines? Okay, so we'll see explanation from each of those areas where we can find inducement. So let's start covering the idea of order blocks. Like, how can we expect to see an inducement where we have order blocks? While we know like order blocks are areas where the market is going to react, and that's a good area for us to take trades. But now, how comes an order block can become an area where price is going to create an inducement trap? Okay, so first let's learn about what is an order block. So an order block is a demand or supply zone that when price reaches, it may potentially change the direction to the opposite direction. So if we were trying to mark an order block, we expect price to bounce from that level, and we expect a movement from the opposite direction from that leg, from that price leg that created that mitigation of that order block. Okay, but always remember, an order block works perfectly when it aligns with the higher time frame direction bias. Okay, so if you're bullish on the higher time frame, we expect some sort of retracement on the lower time frame into a point of interest where we can actually mark our order block, and then we can expect price to bounce and go in the opposite direction. Okay, so how comes an order block become an inducement? It is because of the following reasons, and I'm going to cover and show you the examples from all of these reasons. Like, why am I saying we are going to expect the order block to become an inducement where there is lack of momentum? And when we talk about lack of momentum here, we are talking about break of structure or market structure shift, as you can see. So we can expect what we call an inducement at area where there is lack of momentum. Okay, the second reason is where we have missing criteria, for example, fair value gaps or liquidity. Okay, so if we miss fair value gap in that leg that created break of structure and from the momentum from that leg, then it means if we are missing a fair value gap from that leg, it means there is lack of momentum. And if there is lack of momentum, then there is an inducement there. Okay, it's not a good area for us to expect price to bounce. Most of the time, it doesn't mean like all the time it's going to act like that, but most of the time, okay, you're going to find that that area, that leg that created break of structure and didn't have any clear momentum, and we didn't leave behind any fair value gap or imbalance, it means that's not a high probability order block. It may actually end up becoming an inducement level. Also, if there is lack of liquidity in that movement. Okay, so if you didn't see any liquidity before formation of that order block, then that means it is highly going to become an inducement area. Okay, the third reason is price leg that failed the fair value gap. So if we fill the fair value gap, or we actually fill the gap, and that leg that created a what you call fair value gap fill, that leg is most likely going to become an area where price is going to sweep before continuation to the desired direction. For example, if we were bullish and price mitigated a bullish fair value gap, then and didn't mitigate the discounted order block, then expect that price is going to actually go back into that order block and sweep the leg that filled the fair value gap and then continue higher. We'll see examples. Okay, so let's take one example after the other. Okay, so let's just check here. This is where we are talking about lack of momentum. Okay, so how comes when you have lack of momentum, you can expect some sort of inducement? Okay, when you talk about momentum, you're talking about a movement with big candles, okay, and with fair value gap being left behind. Okay, so look, for example, look at this example here. Okay, you can look at this leg here, okay, same way with this leg. Okay, if you look at this leg the same way, if we look at this leg. Okay, so these three legs are where price was moving. For example, the first leg here, you can see we didn't have any imbalance. The area we had imbalance was this. We had this small imbalance here, but remember this was an area where price was accumulating. You can see there was some sort of accumulation here, so it was not a good area where you can expect price to actually bounce from. Okay, that's another thing for you to add when it comes to marking or actually choosing the best order block. Don't choose an order block from an area where we had some sort of consolidation. Okay, because most of the time price will not respect this zone, will just sweep it and then goes that desired direction. Okay, so you have to be very careful when it comes to marking a good area where you can actually use as your point of interest. Okay, where you can take trades. So this was not a good area because of this consolidation movement here. So the leg was not good because we lacked some sort of momentum here. There was no clear momentum here because price just consolidated a bit from here and then went up. So this area is not a good area for you to take a trade. It's not a good demand zone. Okay, so it's not going to be a good area for you to choose your order block from. So you need to be very careful. Okay, another thing, I talked about this leg. You can talk about this leg here right now. Okay, look at this leg here. There is no any clear imbalance. There is no imbalance. You can see just a very small imbalance, and it is not in the discounted zone, because if we are expecting some bullishness, okay, we expect the price to actually respect what? To respect the discounted fair value gap. Okay, we had a fair value gap here at the top. The same way, even if you can look at this, you can see that we had some sort of respecting this. Okay, price a bit respected that, uh, respected this order block here, but it was not a good area for you to take a trade, because that was not in a good zone. Okay, because price was like consolidating here. Okay, no momentum. You can see like the price was more consolidating, no clear momentum right there. Okay, there was no any clear momentum right there. See how price was accumulating there. There was no any clear, okay, no any clear, sorry. There was no any clear momentum, okay, because price was like consolidating there. The same way with this area, the price was like consolidating, okay. We didn't have any clear momentum there, so we are lacking momentum. So which means if you're going to mark any kind of order block from these areas here, it's not going to be high probability order block, but it's going to be an inducement level. It's going to be an area where price is going to use them as a trap area to actually sweep out or to take out those early traders before the real move. Okay, you can see even what happened here. Okay, price right there tried to respect this. Remember that's order block there. Price a bit tried to respect that order block, but what happened is price didn't continue going up. In the end, it's just ended there. Okay, So it means the leg just went a bit, and then we had some sort of consolidation there before price went down and swept this previous low. Okay, you can see how price didn't respect. Okay, price didn't respect this previous low here. Instead, price swept it. Okay, this is what we call now an inducement. Price decided to take out this level here before the true move. So you can see the true move. This was the true move. Okay, price went higher with a momentum, and this is a good example of what we are trying to look for. If you are trying to look for a good order block, then there is need to be a momentum. Okay, and there is need to be a break of structure, and a fair value gap has to be left behind. Okay, so if you look closely from this other areas here, there is no any good momentum. Same way with this area, if you use that as your order block, you can see price didn't create a clear break of structure. No break of structure. This is not a clear break of structure. Okay, it's not a clear break of structure because just a wick went above the previous candle high here. The previous high, not the previous candle, the previous high. Okay, which means there is no way for us to actually mark this as a good break of structure, and also there is no any imbalance, okay, which can actually be used to give this order block a reason for it to actually hold the price. So you can see that's why price didn't respect this order block also. Okay, so it is very simple like that. No momentum here, just some sort of consolidation. There is no any clear momentum. Okay, that's why this area here didn't actually give us any good setup for us to take a trade. Another example is this. Okay, you can see about the momentum. Okay, how can we actually see momentum from the chart? So if you look at this here, you can clearly see everything here. Okay, look on how easy it is. You can see very easy to see the fair value gaps. Okay, it's very easy to see fair value gaps. Very easy. Okay, the same way with this leg here, it's very easy to see the fair value gaps. Okay. So now we're talking about momentum. How can you see the momentum? You see the momentum from the price leg. Look at this leg here. You can see it was a very highly volatile movement up. It has created break of structure and even broke this major zone here, which was the major break of structure. Okay, so you can see there is a high volatility here. Price was moving with a high momentum. Okay, and that's why we say we have a momentum. We have more than one value gap, which gives us the confirmation that this leg here has doesn't lack momentum. That's why if you are going to look for a good point of interest or an order block, then if you mark this area here as an order block, price is actually going to respect this order block. Okay, that's why you can see here price tap into this order block like snipe here, like a sniper entry. Okay, price tap into this and then went higher to the upside. Okay, that's how it is when we talk about marking order blocks and how can you expect an order block to become an inducement or not an inducement. Okay, so here we are seeing the reason why we can say these order blocks, they are not inducement areas, because there was momentum here. You can see momentum in all this. Okay, leaving behind the value gaps, creating break of structures and market structure shifts. Okay, that's a very good reason. Okay, very good reason to give these order blocks the expectation that price is going to bounce from these regions. Okay, so that's the first reason. Okay, because here we are talking about how can you expect an order block to become an inducement if it lacks momentum, like what I have shown here. I showed you here, like this here, like here we didn't have any clear momentum. Just price was like consolidating, no clear movements, which means now any order block that you're going to mark is going to become an inducement because it's not going to be able to hold the price. Instead, it's going to be swept, like what happened with this here. Okay, you can see here, price swept this low because there was no any high volatility or there was no any momentum. It was a very poor price action. Okay, because there was some sort of consolidation there. Okay, not a very good time or very good earlier to take trades. Even though you mark your order book anyway, it's not going to be working. Okay, maybe it will work a little bit and then reverse in your direction and take you out. Okay, so that's how simple it is. Now let's continue with another reason as to why an order book can become an inducement. Okay, so if the price leg if there is the price leg that fills the fair value gap, okay, can become what? An inducement. Okay, as you can see from this first chart here, okay, you can see we have this, you can see this leg. You can see this leg here. Okay, you can see this leg where we have fair value gap there. Okay, and also we have a fair value gap down there. Okay, we have two fair value gaps. Okay, and then what do you see here? You can see here clearly that there was this leg here, this leg which filled the fair value gap. You see this leg up to there, this down movement, okay, this down movement that filled this fair value gap. Okay, the one that filled this fair value gap. So you can see this fair value gap was filled with this leg. Okay, this movement to the downside is the one that created a filling of this fair value gap. Now we went a bit higher, and then what do you see here next? Is that price came and swept this, the low, or we can say the string low of this leg that created that filled the fair value gap here. So it's very easy to see. You can see here this leg. Okay, this is we filled this fair value gap here, this one. Okay, with this leg down, with this movement to the downside. Now, if this movement to the downside is the one that filled this fair value gap, what happened next is that price went down again and swept this leg. Why? Because there was an order block here which was not mitigated. Okay, we had an order block here which was unmitigated, and there was already a turtle soup here before formation of this order block. Okay, so you can see this order block was a high probability order block. That's why you can see price didn't just leave behind this leg, didn't leave behind this order block without filling. That's why price had to go down again, sweep this leg that filled the fair value gap, and then continue going higher. So that's another way to understand the order blocks and why, and understanding inducement. Okay, so you can see if you were going to mark this as your order block for you to actually take trades, it was going to actually cost you. Okay, if you could use this here as your order block. Why? Because this order block is in the leg that filled the fair value gap there. Okay, filled this fair value gap there. So it was not going to be easy for actually having a very good movement here, because price was supposed to go down again, tap into this bullish order block which was left behind before continuation to the upside. Okay, so we go and check another example. You can see here also price filled this fair value gap here. Got that fair value gap there, and you can see this movement that filled the fair value gap there. You can see price didn't just let it like that. Okay, price went down again. Because why? Because this leg missed, this leg didn't, this leg that mitigated or filled the fair value gap didn't tap into this order block. Okay, this leg here didn't tap into this order block down here, which was a high probability order block. And that's why you can see price had to go back again, tap into this bullish order block before continuing going to the higher. Okay, I hope that is understood. So if you see a leg that filled a fair value gap, if there is any sort of an order block there that was formed after price filled the fair value gap, from that leg that filled the fair value gap, don't mark that order block as a good point of interest, because that order block is going to act as an inducement, and price is going to sweep that level before going into the correct point of interest or order block. Okay, I hope that is understood. So it is simple as that. Okay, let's talk about support and resistance levels. How come support and resistance levels can act as inducements? Okay, so if you have a support or resistance and there is an order block on those levels where we have support and resistance, then it means that those order blocks are not going to work. Same thing you can see here. We have this order block there. Okay, this order block here. You see, we have that order block. Okay, we have the other order blocks. You can see the other order blocks there. Several order blocks. Okay, you can see even the one that was marked there. You can see we have several order blocks. All these order blocks didn't work out well. Why? Because they were around an area where we have support. Okay, like you can, if you're marking support levels, you can mark them at this area here. You can see it's like this is a support level here, and that's why price was bouncing here several times. Price was bouncing several times. Okay, several times we had price bouncing there, and that's why you can see the last touch. The last touch ended up sweeping. Okay, the last touch didn't actually respect these support levels. Okay, the last touch didn't respect the this support level, instead swept this support level before going higher. You see that? Okay, look at this carefully and you will see we have this support level and price didn't respect this support level because it is not a good high probability area. So if you have any order block on this kind of structures, like where you have support and resistance levels, it means that order block is not going to work. It's going to act as an inducement. Okay, so you have to be very careful when you're actually marking your order blocks. Okay, the same way with this example here, you can see. You can see there. Okay, you have this some sort of resistance here, some sort of support, not resistance, some sort of a support here. Like price ended up sweeping that. You can see this leg. This leg here is on that swept this support level. This support level was swept. Okay. So this is the support level that was swept by this leg here. Okay. From the top here, from the top, this is the same leg that swept this support level. Why? Because this acts as a resistance. So if you're going, if any trader try to mark any order block inside this support levels, that is going to become a very good inducement point. Okay, and you can see even here there are several order blocks inside. This didn't work out. Okay, all these order blocks didn't work out well. Okay, so you can't mark a good order block expecting it to actually work perfectly if it is at the region which is an inducement area. Okay, like this area, the support and resistance levels, they're not going to give you good order blocks, but instead they're going to give you areas where prices are highly going to be manipulated and you're going to be taken out of the market. So better be careful with these areas. Don't mark any order block which is inside support and resistance levels. Okay, don't do that. Make sure there is liquidity sweep before formation of an order block, like what happened next. Okay, you can see this, how good it is, this one. Why? Because there is liquidity sweep here. There was liquidity sweep before formation of market structure shift and before retracement into this bullish order block. Okay, that's how it is important when it comes to understanding marking of the point of interest. Okay, another thing is the swing highs and swing lows. Okay, these are also areas where we can expect price to form inducements. Okay, so you can see they are the highest and lowest points that price has recently hit. They create the dealing range. Okay, so they create the dealing range. So price tends to create fake breakouts before reversing. Okay, those swing highs and swing lows, you can see like what we have there. swing high, then we had that sell side liquidity, then that swing low there. Okay, there is a different way of marking these swing highs and swing lows. Okay, so there are always has to be liquidities before, like what I'm here. We had this buy side liquidity there, and then price went down. Again, we had this sell side liquidity here before price formed this. So we have this swing high and we have this swing low. Okay, and these areas are going to actually act as areas where we can expect some sort of inducement or liquidity being created before price go in the direction that we desire. Okay, so you can see there are different kind of liquidities here. Again, you see price sweeping the previous low here, forming a new low, and then creating market structure shift or change state of delivery, and then you can execute. See how simple it is. Okay, so price tends to actually create market structure shift after formation of swing highs and swing lows. For example, here the swing low was formed, and then that's where again price went down and went in the desired direction, which means these swing highs and swing lows will always act as areas where you can actually find inducements. Okay, you need to be very careful in marking these swing highs and swing lows so that it may be easy for you to actually see how you can take trades depending on that. Okay, the same way you can see here, swing high, swing low. Okay, what happened is that price actually swept liquidities here. Before formation of this new swing high, price created a buy side liquidity here. Okay, and before formation of this swing low, price created a bit of sell side liquidity. That's why you can see price went back to this order block, the bearish order block, and then we had a very nice drop to the downside. Why? Because we already had some sort of inducement there. Okay, price disrespecting this level here and creating a trap. Again, creating not a trap, and creating what we call a strong high. Okay, and then price went down, creating market structure shift or break of structure, and then we had a retracement into this bearish order block before price dropped. Okay, so that's how it is nice to understand about the concept of swing highs and swing lows. Okay, another thing you can see here, the swing highs and swing lows and how they work out perfect. You can see swing high, swing low before price swept this. Okay, so there is sell side liquidity here. So after sell side liquidity, wait for market structure shift right here. Then after market structure shift right there, mark your order block and look for if a value gap if there is, and then you can see everything here, and then perfectly price will actually react. Okay, so the other example is when we talk about trend lines. Okay, look at trend lines, simple in trend lines. Okay, trend line is like this one. You can see this like a trend line. This is a trend line. Okay, price is creating trend lines, expecting price to bounce on these levels. Okay, expecting price to react from these levels, but what happened is price disrespect this trend line there, and instead it goes into the desired level, which is an order block, the bullish order block there, and then price goes higher. Okay, so you can look at clearly. Okay, this is an example of the trend line, price creating that trend line and then disrespecting the trend line and tapping into this bullish order block before going high. Okay, so be careful when you see trend lines. It's not a good area for you to take trades. It is an area for you to be careful. Another example of trend lines, you can see here how there are different levels of trend lines and price disrespect these trend lines. Okay, so it's very important to understand about trend lines. Okay, that can be used as low resistance liquidity runs. Like here, it's a low resistance liquidity run. Okay, because price just swept this all of these levels that were created and formed the trend line. Okay, another example of trend line you can see there. Okay, on how trend line were disrespected. Trend line you can see. So we expected price to keep on respecting this, tap into these levels of trend lines. But what happened here is price didn't respect. Okay, yeah, price didn't respect this level. Okay, instead went above it, created market structure shift there. And after market structure shift, you can see price came down into this order block and we had a nice buy from that level. Okay, so you need to know exactly on how to mark areas in order to avoid being trapped with inducements. Okay, the same way you can see how this order block worked perfectly because we had fair value gap there, we had a very good retracement, and you can see this leg that filled the fair value gap. This is the leg that filled the fair value gap. Okay, this leg, there was a fair value gap there. Let me show you clearly. Here we had a fair value gap there. Okay, and you can see this leg, this leg. This leg, I can just show it clearly. This leg there, you can see that leg. Okay, that leg is the leg that filled the fair value gap, and you can see next what happened is that price went up a bit and then went up and then again it reversed and came down into sweeping this leg. Price swept that leg that formed or that filled the fair value gap and then tap into this to this bullish order block. So that's how you can actually keep on learning and understanding about inducements. Okay, as an example of trend lines, you can see here several levels where price was actually bouncing. Okay, you can see 1, 2, 3. That was a trend line, but the first move didn't respect the trend line. Same way with this 1, 2, 3 tap. The fourth one didn't respect. You can see it didn't respect. Okay, that's how trend lines actually becomes traps. So wherever there is a trend line, don't actually mark any order block. Don't look for any order block. So you may try to mark several areas as your order blocks, and it's not going to work. Okay, like here, you can mark that as your order block. And you see, but because you're marking an order block in an area where there is a trend line, it's not going to work because you're marking an area where there is high level of liquidity, high level of inducement. Okay, there is inducement there. So you can just mark like that. So now what's liquidity? Okay, although I've already said liquidity and inducement, they look the same, but there is just a small difference. Okay, so when you understand liquidity, it's going to help you to identify liquidity zones, and it's going to help you to avoid being trapped at a high percentage. Okay, so what exactly is liquidity? So liquidity is just money or like orders that must be fulfilled. So the market always needs to sweep liquidity in order to gain momentum. Okay, so the price needs to actually form some sort of liquidity areas, sweep those liquidity zones, and then moves. Okay, so because it is important to actually create this liquidity in order to increase the momentum of price. Okay, so liquidity is used as the fuel of the market. So how do you know where liquidity is? So liquidity is a zone that on the chart that where like the pool of money is resting. Okay, so there can be buy or sell orders, such as stop losses. Okay, so where there is a lot of stop losses of traders, that's where liquidity is resting. Okay, because when someone gets stopped out, that money gets taken by the market. So the market is going to actually make a lot of money if you lose money. So it means there are kind of areas that's going to be created, attracting more traders, more retail traders into executing trades. And then if they execute trades, they are going actually to become liquidated. They're going to be taken out of the market. Their stop losses are going to be hit and they're going to be out of the market. And when they're already out of the market, that's where the market's going to go in the same desired direction as they predicted. Okay. So liquidity zones are found below or above the equal highs and equal lows. It can be on the swing highs and lows, can be on trend lines and support and resistance. So this is how you can find liquidities. Okay. On equal highs and equal lows, swing levels, which are swing highs and swing lows, trend lines, and support and resistance points. Okay. So what is the difference between liquidity and inducement? What exactly is the difference? So liquidity doesn't take traders into the market, it takes them out. Okay. So liquidity takes traders out of the market. Okay. So when there is liquidity, it means price is going to just sweep that liquidity, take those traders out of the market. Okay. And then create a very good chance for traders to look for entries and trade. Okay. But an inducement forces traders to get into the market. So an inducement is an area that's going to attract you, like it's going to attract more traders to actually see it as a very good zone for them to execute. But eventually they get caught by the traps that the smart man or the market makers have already designed for them. Okay, which means inducement always attracts more traders to enter or press their trades. But liquidity, it takes out those traders. It means in liquidity, there is no need to actually attract more traders or make traders get into the market. Okay, because liquidity is there in order to make the market move. Okay, so it means there is no need for liquidity uh, to actually make traders more traders to enter into the market, because liquidity is there in order to increase money in the market. Okay, so we hit stop losses of a lot of traders, make more money, which increase the volatility of the market, which increase the momentum of the market. Okay, but an inducement is an area that is going to attract more people, more traders to get into the market. And then when they enter into the market, they end up getting caught out by the smart money. Okay, that's the difference between inducement and liquidity. Okay, so you can see some of the examples here of how we can use the concept of liquidity and inducement to make more high probability trades. Look at these chart examples here. Very good chart examples. Okay, you can clearly see very good chart examples. Formation of an accumulation here, price sweeping liquidity, price creating this market structure shift there, price coming down into this fair value gap, filling the fair value gap and tapping into this big order block before it will move to the downside. Okay, you can see how nice it is. Very nice, very nice, very nice. Okay, same way with another illustration here, you can see the way we can see the inducement. Okay, so the first example here is the example of liquidity sweep. Okay, how liquidity is, because liquidity takes those traders out of the market. Okay, why? Because most traders expected this to act as a resistance zone. Okay, they saw it been holding price for 3 touches, so they can expect like, oh, I expect the price is going to actually, it's going to bounce here. The same way it bounced on these previous levels, I expect it to bounce again. But what happened is the market did not bounce, instead it swept. Okay, took them out of the market. You can see this right here. Okay, before actually going down. Okay, so another example is the example of inducement. So you can see inducement, how inducement is. Inducement attracts traders to come and buy into that zone. It attracts more traders to come and buy into this support level. Okay, but at the end of the day, what happens? Price sweep goes down into the desired direction before going in high. Okay, so you can see this example here of how you can see an inducement. Okay, this is an inducement because it may look like an order block. It look like a very good order block there, but it is not a good order block because there is another order block at the discounted level there. Okay, and this area will act as an inducement now because price is going to attract more traders to actually take buys from this order block. And once they try to put their trades here, the market is going to go down, tap into the discounted order block before going higher. So you can see how simple it is. Okay, it's very simple. It's very, very, very simple. Okay, another example of inducement is this. Okay, you find equal highs below your bearish order block. Okay, before the premium bearish order block. So this is a bearish order block there. Okay, and below it you find these sorts of equal highs, which means these are going to act as an inducement. Okay, because they are going to attract more traders to get into the market and execute on these levels, because this level where we have equal highs will tend to act as what? As a resistance zone. Okay, so most of traders will expect price to bounce from that equal high level and just continue going down. Instead, what happens next is that price will go down a bit and then moves very fast from this movement there. Okay, that's how price does. Okay, it goes into the desired direction and then boom. Okay, so you can see the example, chart example. Okay, see this, we have equal highs here. Price sweeping this equal highs, which is their inducements. Okay, so these are inducement levels. Okay, price takes, sweep these equal highs, tap into the desired order block there, and then continue going down, creating this breakout structure there, again forming these equal highs there. Okay, we're expecting price to come down into this start touch there and continue going down, but what happened is price sweep these equal highs, goes into the 50% of the order block, fill it, the 50% of the order block before going down. You can see it's very easy. It's very easy and very simple to understand about liquidity. Just need to practice more. Okay. Another example you can see here. Okay. You can see how everything happens. Okay. You can see everything. See how an inducement can be observed. You can see this is an inducement. Okay. Why? Because price will have to actually sweep this before coming to the desired order block. Okay. Why? Because this order block also has an imbalance and there is momentum. Okay. That's how simple it is. Let's check another example. Okay. You can see another example here. Not much different. Okay. So this is an inducement level. Okay. This is an inducement level. This is also an inducement level. Okay. And immediately price sweep this inducement level and start reversing. Okay. And there is always an order block above this inducement. Here there is an order block above this inducement level, and here there is a fair value gap above this inducement level. Okay. So that's how simple it is when it comes to. You just need to practice more. Same way with these examples here. Okay, you can see price creating liquidity sweep. Okay, before formation of this order block, before formation of this fair value gap, before tapping into this order block. Okay, and sweeping this level here, and it becomes an inducement, IDM. Okay, it becomes an inducement. Why? Because there is always need for price to create inducement before price goes high. Okay, if you want to know the difference, you can see now this is liquidity. Okay, this is liquidity. It takes traders out of the market, but this is inducement. Why? Because it attracts more traders to try to trade. Okay, why? Because they may think like this is going to act as a resistance now. Okay, so they may think this is going to act as a resistance, so we can actually buy from this region, but instead price actually swept this previous low here, and you can see how price went high. Okay, another example you can see here. Okay, an order block at this inducement, got another inducement here, equal highs even there, and then tap into the order blocks, and nice, very nice, very nice. Okay, another example you can see here, price sweeping these areas of liquidities, this area which are inducement levels. Okay, and you can see this is liquidity. Why? Because this is buy side liquidity, and after buy side liquidity you can see price drop down, created this change in state of delivery there, went down. Okay, again created this inducement here. Okay, attracting more traders to sell from that region, but what happened is price didn't respect this accumulation area. Okay, which will act as support and resistance, but price broke above it, tapped into this fair value gap. Okay, at the same time price mitigated this order block. So you can see how nice it is. Okay, very, very nice. That's how it is. Okay, so another example you can see here, very nice example. Okay, because we have this inducement there, and we have this order block there. It's a very nice trade here. Okay. You can see more examples and more and more examples there. Okay. A lot of examples. You can see so many. So this PDF contains a lot of examples. About liquidity and inducement. But because of time, I don't want to explain everything here. So you can see even this trades executed. You can see nice way of taking trades. Okay. Nice way of taking trades. You can see again how this data didn't get respected. Okay, you can see how this became an inducement because there is this premium bearish order block which was tapped here. Okay, you can wait for more confirmation and enter from this after SMT smart money trade in the smart money tool. Okay, smart money divergence. Okay, so it's very easy. It's very easy. Another example is here. You can see how price did it. Okay, you can see how price created what we call liquidity sweep. This is liquidity sweep. But after liquidity sweep, you can see price reversed, created market structure shift, and then tap into this order block there, and you can sell from there. Okay, very simple trade. Okay, so these are beautiful examples. Okay, so guys, up to there, I think there's nothing more to explain. I hope this video was educational, and so don't forget to like, comment, and subscribe. Okay, thank you guys for your time.